It's fair to say the numbers out of China recently have been underwhelming, and that's being polite. Would you expect property prices and demand outlook to be much different?
Okay. We do expect a moderating trend in China's property market after a strong start this year. Sentiment clearly deteriorated since the beginning of Q3, given that the policy tightenings targeting the overheating cities and indebted developers have dampened the outlook. For housing prices, we think that the average price will likely to stay broadly stable in the rest of this year with mild correction, because the developers are likely to start cutting their selling price in order to accelerate their sales revenue collections. But the downside room would be rather limited given the already high land acquisition price. On housing transactions, we think that the housing sales is likely to remain sluggish in the rest of this year, given the persistent restrictive measures.
Yeah, do you expect this to be causing some pain for property developers when it comes to refinancing?
Yes, actually, developers' financing conditions improved in the first half of this year with their credit access picking up and funding costs falling. This gives them a better position to cope with the difficult times ahead. But the recent policy tightenings, which mainly controls developers' funding channels, we think will likely to put more pressure on developers' cash flows and will force them to accelerate sales. We see that the housing revenues accounts for about half of developers' source of funding on average. For smaller ones, this ratio is even more higher. So if housing sales remain weak, we think that the tightening of the financing conditions will eventually weigh on developers' activities and will lead to further consolidation in the sector.
Lawrence, so do the Hong Kong protests affect what's happening in mainland China at all?
We think the Hong Kong protests will definitely affect the investment appetite for onshore investors to Hong Kong market, and it will also cause the slide of GDP growth as well as capital flight in Hong Kong market. So the negative impact will last for some time.
The Chinese yuan is still trading at around that 7 level. Does the weakness affect the property markets? We do think that the exchange rate is directly driven by the market force right now. So the monetary policy and the policies on the real estate market may have a bigger impact on China's housing market transactions. So for now, as we get disappointed real activity data in Q2 and July, this is likely to elicit more stimulus measures from Beijing, especially on the monetary policy side. For example, a possible RR cut and market interest rate cut. But we think that Beijing will continue to improve credit support to private sectors and manufacturing sectors instead of property sectors. So financing conditions for developers will remain relatively tight for the foreseeable future. But if China's GDP growth reaches dip below 6%, we think that Beijing, of course, can temporarily ease its housing controls.